Hi, everyone. I want to go ahead and talk about materiality here, which we have been saving for the end of chapter 3. And when we look at the concept of materiality, okay, my clicker's giving me a hard time here today. If we take a look at the concept of materiality, what we're basically saying here is that an auditor wants to direct their audit resources towards financial statement line items that have a more potentially material effect on the decision maker of the users, investors, and creditors of those financial statements than others. It is a way of efficiently deploying audit resources towards those larger account balances, looking at it from a quantitative standpoint, or maybe not so much from a quantitative standpoint, but a qualitative standpoint as to areas that may be more sensitive to, again, we're thinking about the users of the financial statements, investors and creditors, and how it might change their investment and credit decisions. So when we take a look at this slide here in the concept of materiality, we say that when establishing materiality, the auditor should determine materiality for the financial statements taken as a whole. So there's 3 levels of materiality. Financial statements taken as a whole, coming over and changing up the thought here a little bit, performance materiality, and when necessary, materialities for transactions, account balances, or disclosures for a particular class of those. So there could be 3 levels, and we're going to see that we're going to do that overall financial statement materiality. We'll come up with a performance materiality that's going to be less than the overall financial statement materiality. And then if we have a particular footnote disclosure that is particularly important, we might even bring that materiality to a different threshold. Okay. Now, materiality is based on professional judgment. Okay. There isn't something in the standards that says materiality has to be set at X% of a particular number. They do tell us that we have to apply a percentage to a benchmark in the financial statements, but they don't tell you that benchmark. They don't say 3% or whatever. It's auditor judgment as to what that amount should be. So when we come over and we take a look at the different levels of materiality, we can see here that we have performance materiality. Okay, and let's take a look at that. And they tell us that performance materiality, remember we had performance materiality, we have materiality for the financial statements taken as a whole, and then we had performance materiality as well, and then we have it for a particular class of transactions. Now, when we look, we can see, going back to the previous slide, factors that are being used to make the materiality assessment. It's going to be the application of percentage to an appropriate financial statement benchmark. Okay, and they tell us that the financial statements may be used by the entity's annualized interim financial statements or its prior period annual statements. So we're going to look at line items, maybe annualizing interim statements. Interim statements would be, say, every quarter, or maybe looking at last year's statements and then applying that percentage appropriately to come up with our materiality levels. Okay. Now, we are going to look at things like, and we look at examples of materiality benchmarks include total revenue, gross profit, profit before tax from continuing operations, et cetera, net assets. It really depends on the nature of the industry. Okay. So we're going to apply a percentage, and I'm going to give you an example here in a little while. We'll apply a percentage to a particular financial statement line item. That will be that first level of materiality that we're talking about, the materiality for the financial statements taken as a whole. Okay. Now, we also have to consider what? Performance materiality. So we come over and we take a look, and forgive me, guys, my Zoom is putting things in my way here. Okay, so I can't see what I want to see here. Okay, here we go. So you can see that, and let's just take a look at that, that performance materiality is the amount or amounts set by the auditor at less than the materiality for the financial statements taken as a whole to reduce to an appropriately low level. I'm sorry, guys, I'm battling with Zoom here today. Okay, to appropriately low level, so that the probability that there will be aggregate uncorrected or undetected misstatements will exceed the materiality for the financial statements taken as a whole. So what the auditor is going to do is they're going to come up with that one level of materiality, the overall financial statement materiality, but then they're going to slice that even thinner for performance materiality. So as I'm doing a particular audit procedure, if I find that misstatement, I will ask for something that exceeds that performance materiality. Say I'm confirming accounts receivable, and something comes back that says the accounts receivable is not fairly stated, and it is fairly stated by amount that is at that performance materiality level. The auditor would ask for an adjustment on that, even though it's below the overall financial statement materiality, because undetected misstatements could aggregate and therefore be resulting in an overall material misstatement. Tolerable misstatement is the maximum error in the population the auditor is willing to accept. And that is the same thing as performance materiality, but now we are applying that to a sampling procedure. So performance materiality, tolerable misstatement are really one in the same. Now, materiality for a particular class of transaction, account balance, or disclosure, in some cases, we may need to even come up with a special materiality for, say, disclosure. For example, let's say there's a situation where the entity's debt to equity ratio gets too far out of balance. There may be some sort of debt covenant that says that that debt is immediately going to come due if that happens. Well, that would be a pretty important disclosure, and we may set our materiality levels even lower in relation to that particular disclosure, because again, if the debt's going to be called, there could be some issue with the going concern of the entity, et cetera. So we might even squeeze that materiality level even smaller. Okay, so when we look, we can see that we go ahead and we have to come up with the materiality as at a whole. Okay, and we will consider, of course, quantitative and qualitative factors. Both must be considered when setting materiality for the financial statements as a whole. Okay, and it needs to be expressed at a specific amount. We're going to see how we're going to do that. And we're assessing materiality, and this is an important one that I'm going to go ahead and change the color of my pen here. Okay, when assessing materiality, the auditor should use the smallest misstatement that could be material to any one of the financial statements. So if we're looking and the materiality for the balance sheet is 20,000, but the materiality for the income statement is 10,000, we would use 10,000 for our overall financial statement materiality because of the interrelationship between the income statement and the balance sheet. Okay, so we're going to have three levels. We're going to have what? We're going to have overall financial statement materiality, applying a benchmark to a particular line item. We're going to have what? Performance materiality, which will come down even lower than the overall financial statement materiality. We're doing that because of the fear that there's aggregate misstatements that will gang up on us and be resulting in overall financial statement materiality, right? And then there'll be specific account balances that will get a level of materiality for it. Now, and when we talk about sampling in our coming up chapters here, with sampling, we call that misstatement tolerable misstatement, simply because we're applying statistical measures against whether that misstatement, we're coming up with a range, et cetera. And we'll get into that more. But tolerable misstatement and performance materiality are basically one and the same. It's just that we use the more technical term tolerable misstatement because we've used a sampling technique and we're able to statistically call out our precision and whatnot. Okay, so you come over and I think you'll get these concepts down pretty easily. We're not going to get into the issue of an account balance, transaction, disclosure level. I think you can understand how we might want to, maneuver our materiality around a particular disclosure. But in terms of the overall financial statement materiality and then calculation tolerable misstatement, this is a good example. Okay, so let's just go ahead and read through this, and we have go ahead and change back to highlighter. Okay, and we have I thought I changed back to highlighter. I guess I just changed the color. So that other stuff, and you can see here the facts are that Evan, a senior accountant at Noah CPA firm, is determining the overall financial statement materiality and the tolerable misstatement for his client in year 2. Now they're calling it tolerable misstatement here because apparently they're going to be using some sampling for this, but we're not going to get into the sampling part. So it's just a term. Could have said performance materiality, and it would not have changed how we're going to do this at all. Okay, it's just depending on the nature of the audit procedure that you're using. If you're using sampling, call it tolerable. If the procedure is not using sampling, then we call it performance materiality. Okay, so Evan expects that there will be a low likelihood of uncorrected and undetected misstatements. Now we come over and it says Noah CPA for materiality guidelines are as follow. Overall financial statement materiality should be based on the benchmark of either total assets or gross revenue, whichever is larger. Okay, so they're trying to direct their audit sources to the correct level of work that should be done. And they've looked at the balance sheet, they've looked at the income statement, and they've said, okay, whichever is larger, assets or revenue, that's how we're going to apply our materiality. And it should be calculated by taking the appropriate benchmark and multiplying it by either 1% if the benchmark is total assets, or 0.5% if the benchmark is gross revenue. Tolerable misstatement is calculated by multiplying the overall materiality by 70% for low likelihood of uncorrected misstatement, or 50%. And look, in our reading of this, we know that we're going to pick up that 50%, okay, because, they've already told us that it's a low likelihood of misstatement. Where was Noah's discussion of the low likelihood? There will be a low likelihood. So already we know that we would pick up what? Pick up this 50%. Now we start to take a look and we see that we have revenue, we have gross profit, we have total assets. We're supposed to consider, per the instructions here of the firm, which one is bigger. And of course you can see, not very hard to understand, right, that the revenue is the bigger. And they tell us that if it's a revenue, then we should apply the percentage 0.5%. So doing the math, 0.5% is equivalent to 0.005. We multiply that by the 2.5, that gives us 12,500 as our overall financial statement materiality. But again, we have to guard against undetected misstatements. So we take our what? Our performance / tolerable materiality, and we bring that down to an even lower level. And since it was low level, I think I misspoke, guys. I'm sorry. It's either 70% for a low likelihood, not 50%. 70% for the low likelihood. Misspoke there. Okay, so we're going to pick up the 70%. Okay, not the 50. 50 was for a high likelihood, whereas 70% was for the low. 50% would squeeze that tolerable misstatement down even more. And we would be doing more audit work there if our materiality level had shrunk down even more, since they're saying through experience with this client and whatnot, they're applying these benchmarks maybe to last year's or annualized interim statements. They know about this client, they can use their auditor judgment, right, to come up with the appropriate level here. And they've chosen 0.7 because of the low likelihood. Okay, so 0.7 times the 12.5 means that my tolerable misstatement is 8,750. Okay, so not a real difficult calculation. I think sometimes we see calculations and percentages and we start to panic a little bit, not that difficult. Okay, so again, materiality, what are we trying to do? We're trying to direct our audit resources towards things that are going to be more important to the judgment of users. Okay, the auditor uses their judgment to determine what is the appropriate benchmark, assets, revenue, whatever it is, and then applying a percentage, and their standards don't tell you what that percentage is to be. You can see that they're pretty low percentages though, right? Apply those percentages to the appropriate line item based on the auditor's judgment. Okay, so the auditor looks at that and the auditor says, okay, we're going to apply that percentage. We do. That gives us our overall financial statement materiality. Then we will come up with performance / tolerable, and that tolerable / performance is going to be even smaller. And the reason we're doing that is we're saying, well, we may not detect every misstatement. There's always a chance that we'll miss something. So we really give ourselves a cushion by squeezing that materiality level down even lower for the actual performance of our audit procedure. So if there are undetected misstatements, we've guarded against that by asking for adjustments of things that fall above that tolerable / performance materiality. Okay, and then again, there's that footnote disclosure issue that we may even want to establish a materiality for that. That's obviously a quantitative look. We'd also consider qualitative aspects. Okay, good. So let's go ahead and let's take a look at a couple of examples of questions here with respect to the concept of materiality. Which of the following statement is correct? That means we've got 3 wrong ones and only 1 right one. And let's take a look. Materiality depends on the nature of the transaction rather than the dollar amount. No, we're applying percentages to dollar amounts. Materiality is determined by reference to AICPA guidelines. No, it's auditor judgment, right? Materiality is a matter of professional judgment. We've said that a couple of times, and you can see that is the correct answer. The last one here, materiality depends on only the dollar value of an interim or relative or other items in the financial statements. No, we said what? Quantitative and qualitative aspects as well. Okay, this one, let's see, we'll go through it together. This is a question that I've taken from CPA material. Let's go ahead and take a look. Which of the following statements, again, is not correct about a materiality? Let's take a look at A. An auditor considers materiality for the financial statements as a whole in terms of the largest aggregate level misstatement that could be material to any one of the statements. No, we said the smallest. If materiality for the balance sheet is 20,000, but for the income statement is 10,000, then we're going to go ahead and we're going to go with that 10,000, right? Okay. An auditor's consideration of materiality is influenced by the auditor's perception of the needs of a reasonable person who will rely on the financial statements. Yeah, that's correct. So that's not the right answer. That's not correct. So right now I'm thinking A is the right answer, but I always like to read through the rest of these. The concept of materiality recognizes that some matters are important for the fair presentation of financial statements conformity with GAAP, while others are not as important. Absolutely, that's what we're doing. We're trying to direct our resources to those things that will be most important to the users. Materiality judgments are made in light of surrounding circumstances and necessarily involve both quantitative and qualitative. We've said that a number of times. So A is not correct. It's because it's not the largest, it's the what? The smallest aggregate level. Okay, good. And that's the answer there. Let's go ahead and let's take a look at another question. In consideration of overall planning purposes, an auditor believes that misstatements aggregating 10,000 would have a material effect on the income statement, but misstatements would have to aggregate 20,000 to materially affect the balance sheet. We would pick the 10,000. We kind of used that here a couple times, the exact numbers in our example, right? It's going to be the 10,000, the smallest level. Which of the following would an auditor most likely use in determining the auditor's preliminary judgment about materiality? By preliminary judgment, we set the materiality levels, near in the planning phase of the audit. But as we go along and we start to maybe discover misstatements and whatnot, we might want to change that materiality level as we're going through. And that's a consideration throughout the audit, practically until you issue the report. You'd keep thinking about that materiality, and you may need to change that as you're moving along. I don't know about up to, the day before you're issuing the report, but it's basically going through all phases of the audit. You keep reconsidering that materiality if necessary. So which of the following would the auditor most likely use in the setting of the materiality? The anticipated sample size? No. Sample size is going to be a product of what our materiality level is. If our materiality level is lower, we will probably have to have a larger sample size to be able to represent, to be able to sample transactions at a smaller dollar amount. So no. The results of initial assessment of control risk. Well, no, we're setting that materiality. And we're setting that materiality so that as we apply the procedures, and that's really the timing, extent, and nature of the procedures would be based on the assessment of control risk. But once we apply the procedure and we find potentially, say, a misstatement, then we're looking at that misstatement against our materiality levels to see if we think indeed there is a material misstatement that we would want an adjustment for, or would we have to qualify our opinion or something, okay? C, the assertions that are embodied. Yes, we consider that, but that is not what's driving our materiality. D, the entity's financial statements of the prior year. Yeah, and we even said that in the outline when we looked at it there, that the auditor is going to look at maybe the prior year statements or annualized interim statements and apply that percentage to whatever the appropriate benchmark is that the auditors come up with in their judgment. Okay, good. Let's take a look at another one. According to the Public Company Accounting Oversight Board standards, when would a company be least likely to reevaluate established materiality levels or tolerable misstatement? Again, reevaluate meaning as I'm going through the audit, if something comes to my attention, I may want to change that materiality. I doubt that you would, in the middle of the audit, increase your materiality levels. Probably things aren't going too well and you're going to decrease those materiality levels because you're starting to get a funny feeling that there might be some misstatements, there might be some detected misstatements, and I want to squeeze that down a little bit more to give myself extra assurance, the appropriate assurance, and by extra, the appropriate assurance that the financial statements are not material misstated. So let's take a look. The client has stated that it will not be able to respond to the auditor's request for evidence within the prescribed time frame. Okay, that doesn't sound good. I don't know that adjusting my materiality levels are going to address that. I would probably start to work with the client to say, well, look, we need this information by this amount of time to be able to complete our audit on time. So how are we going to work this out? Is there something that we can do to get the information to us on a timely basis? But you're not going to start fudging around the materiality levels. So this is not good if this happens in the audit, but I don't think we would jump around with our materiality there. B, materiality levels and tolerable misstatement were originally based on estimated or preliminary financial statement amounts that differ significantly from actual amounts. Okay, that is starting to sound like there's maybe some problems going on that I want to protect myself by lowering my materiality, but let's see if there's something else here. C, there's a substantial likelihood that the misstatements of amounts less than materiality level established for the financial statements as a whole would influence the judgment of a reasonable investor. Amounts less than the materiality level established for the financial statements as a whole. Okay, I'm looking at that and thinking that's important. And I'm starting to realize that I'm answering this question. I make this mistake. You got to be careful with this mistake. It says would be least likely. So I'm getting rid of A because I'm thinking most likely, and it's starting. And this is why it's always important to read all the choices, because I was ready to get rid of A, and now I'm thinking A is good because it says least likely, right? So B sounds like a reason to adjust materiality. As I read through C, I'm like, okay, yeah, C would be a reason as well. What the heck's going on here? Send me back up into the stem of the question. And now I'm looking, I'm saying, oh yeah, it says would be least likely. Yeah, A is probably the least likely reason so far. Let me look at at D. Changes that occurred after the materiality levels were originally set are likely to affect investors' perceptions about. So changes have occurred. I'm going to adjust that materiality. So A, yeah, if they're not giving you the data in time, changing your materiality is not going to help. You're going to have to address that, but not through a materiality adjustment. You would likely, try to figure out, well, do we need to, do you need to get some additional staff in here? Do we need to get some staff in here that can help you to pull the documents that we need? Do we need to reassess our fees because the contract, the engagement letter says that you'll be providing this, and now you're saying you can't do it, etc. There would be discussions that are outside the realm of materiality. These other three, yeah, these are good reasons as to why you would want to change. So the least likely one is A. Okay, good. Let's take a look at this one. Tracy, senior accountant at JFM CPA firm, is determining the performance materiality for her client in year 2. Tracy expects that there will be a high likelihood of uncorrected misstatements. Okay, I'm going to underscore that because I want to remember it's a high likelihood. GFM CPA firm materiality guidelines advise that the auditors is set performance materiality in the range of 50 to 70% of overall materiality based on the likelihood. Tracy has calculated an overall materiality of 140,000. So we're trying to come up with that performance / tolerable here. We're calling it performance because I guess we're not applying audit procedure, sampling procedure to that 140,000. They've said it's what? A high likelihood. Now, unlike the example that we looked at, they're not telling us what part of the range is high versus what part of the range is low. But think about it. If you apply a higher percentage, right? You apply that higher percentage, well, that higher percentage is going to make that materiality level larger, meaning that you're not going to be looking at closely at transactions, right? There's many smaller transactions, I don't know about many, but there's smaller transactions that will fall outside of your scrutiny, right? Whereas if there's a high likelihood of material misstatement, then what? I'm going to use that lower end of the range. That'll bring that number down. And as that number comes down, that means my audit scrutiny is going to be going to a much broader universe of the transactions. I don't know if I should say a broader universe, but I'm sitting there and I'm saying, well, if I find a misstatement of a smaller amount, I'm going to start to investigate and potentially ask for adjustments, et cetera. Okay, so I go ahead and I multiply that times what? The 0.5 is what I pick, and I get 70,000. And I look at 70,000. I'm like, okay, yeah, that's the answer. Okay, now I don't know. Could you have applied? And I didn't think about this before I started looking at this, but let me take a look here. I don't know that if I pick 140,000, my benchmark, and I apply the 70%, do I even come up with one of the answers? Yeah, I do. Choice A, but that's not right. I said high level of misstatement. So what am I going to do? I'm going to bring that materiality level down. That's going to cause me to get deeper into the transactions. If I find a misstatement, then I'm going to do what? Then I'm going to say, hey, what's going on here? This looks like a material misstatement to me. Do I want an adjustment? Do I want to now expand my sample size even more to try to find out what's going on? Do I want to squeeze those materiality levels even more now because I'm sitting here and I'm making changes as the engagement goes on? Okay, this is just my preliminary, etc. Okay, so the answer here is 70,000. Okay, good, guys. I just want to spend that little bit of time here taking a look at the materiality discussion with you. So we will be proceeding with the rest of the materials we go on. All right. Thanks, guys. We'll talk to you soon.